Distinguished participants, it's my pleasure to welcome you all to this ICSAN workshop on statutory returns and regulatory compliance workshop. Today, 11th of May, 2021. We welcome you to the training of the Institute of Chartered Secretaries and Administrators of Nigeria, ICSAN, the hub of governance professionals. Today, we are in for a good time. I know that our facilitator is ready to deliver her paper today and also impart knowledge to you, our esteemed participants. So I'd like to encourage us to please pay attention to our speaker for today. But before we go into that, for the benefit of those of us who may be attending the ICSAN training virtually for the first time, I'd like to intimate us with some of the ground rules regarding this training. This is a 2-hour session. We'll have a 90 minutes presentation, and then we'll leave the remaining time for question and answers, contributions, comments, and all the others. Your mics have been muted by default, so please do not unmute until it's time for question and answer. We have your opportunity for questions at the end of the presentation, so you can type your questions in the question box, and you can also use the icon which signifies that you have a question. It really signifies the raising of the hands for a question. You can also use that to indicate that you have a question and you will be attended to. At the end of this workshop, we're going to have a group photograph, so we'd like you to enable your videos at that time, and even when you are asking your questions, you can also enable your videos. And of course, we're going to avail you the materials for this workshop. So I just felt I should let us know that. Okay, having said that, I'd like to introduce our speaker for this interesting and wonderful moment that we are all looking forward to. Our facilitator for today is a graduate of law from University of Lagos, and she was called to Nigerian Bar in January 2001. She has relevant expertise in legal advisory, company formations and restructuring, company secretarial, regulatory compliance and government relations, immigration law, employment law, policy formulation, and corporate commercial legal practice. She's actively involved in most of the firm's corporate commercial transactions by leading in the review of the regulatory and compliance aspects of such transaction. Our speaker also leads on most of her firm's interaction with government ministries, departments, and agencies. She advises clients, both local and international corporates, on regulatory aspects of their businesses towards achieving optimal compliance and performance, and has also advised the federal government of Nigeria on notable business reforms in Nigeria. Our speaker for today is a member of the Nigerian Bar Association, an associate of this prestigious institute, ICSAN, as well as the Business Rescue and Insolvency Practitioners of Nigeria, BRIPAN, and she mentors women on the platform of Women in Successful Careers, and has also authored several articles. Distinguished participants, join me as I welcome to take the floor our esteemed speaker, Mrs. Toyin Bashir, a partner at Banwo and Igodalo. Good morning, Mrs. Toyin Bashir. You have the floor. Thank you.
Good morning. Thank you. And thank you for such a warm welcome. Thank you very much. Good morning, dear participants. I bid you a warm welcome. I join the Institute in welcoming you into this morning's workshop, being, of course, organized by our very esteemed Institute. Permit me to use this opportunity to thank the President and the Council of our esteemed Institute for organizing this workshop. I believe on such a relevant topic, and for the privilege, of course, of being invited as a resource person for the workshop. It is another of the very many ways I believe that the Institute, under the leadership of our very able and capable President, Mr. Bode Ayeku, FCIS, and the Council's commitment to keeping members and external stakeholders abreast of contemporary developments which are relevant to effective discharge, I guess, of our roles and responsibilities as corporate governance professionals in Nigeria. So, of course, as you was aware through the introduction, the title of the workshop is Statutory Returns and Regulatory Compliance. So, essentially, the objective of the workshop is to provide you participants with insights as to the current statutory and statutory return requirements, I guess, as provided for in the Companies and Allied Matters Act, and some insights into statutory return requirements in relation to public and listed companies. So I'll use the opportunity to highlight some of those requirements under the law, as well as certain applications which are required to be filed at the Commission, with specific reference, of course, to timelines and for lodging such applications at the CAC. So as professionals, I think it's important that we stay aware of the applicable timelines for filing of such documents at the CAC so as to minimize, I guess, our clients or companies' exposure to compliance infractions or violations. So there's no gainsaying that CAMA 2020 is one of the most relevant business legislations in Nigeria. So it's also very important to the work that we do as corporate governance professionals in Nigeria. So this workshop is a deliberate effort by the Institute to utilize this platform in familiarizing members and external stakeholders with relevant provisions in CAMA 2020 so as to support the effective discharge of our responsibilities. So my approach would be to highlight those provisions in CAMA as I mentioned, using the different legal vehicles that were created by the law and the applicable statutory returns and filing requirements for each legal vehicle. So during the course of my presentation, I'll be highlighting returns which are applicable to public companies as well. I will also touch on some additional statutory returns applicable for such companies, including listed companies, as provided for in the relevant subsidiary legislations which regulate, the operations of such companies. Then I would also touch on some tax returns, some statutory tax returns, especially as they relate to those legal vehicles which have been established by CAMA 2020. And I guess lastly, I'll speak more generally around regulatory compliance, and I highlight, the roles and possibly the responsibilities of regulatory compliance officers, either as professional services providers or as in-house counsel, and basically just provide practical insights as to how compliance policies and procedures can be, developed effectively. So I really hope that at the end of this process, the slides will also serve as sort of like a resource document which participants may refer to. I think maybe some kind of like a cheat sheet, or is it a cheat document, when you need to quickly identify relevant statutory returns at every given point in time, you can have reference to the document. So I am going very quickly to start sharing my screen, and I'm also even saying, I'm hoping that you can hear me because I'm seeing that my network is a bit unstable.
Yes,
So
we
I'm
can
hoping
hear
I'm
you,
still
ma'am.
audible. Okay. So I'm just give me a few seconds to share my screen. Is the screen visible?
Yes, the screen is visible, though you can still enlarge it.
Is this fine?
Yes, yes, yes. It's okay. Yes. It's okay, yeah.
Just a second. Sorry, just a second. I'm trying to adjust this. Okay. I'm hoping I'm still. My network keeps giving me prompts that I'm not. That is unstable. I'm hoping you can still hear me.
Yes, yes, we can hear you.
Okay, all right. I think I'll just minimize the risk of that and just continue as it is, so far as I'm audible. So, so starting with the first return here, like I had said in the introductory remarks, I'm just going to talk more around the CAMA first because that was also one of the objectives of the workshop, and I think that as much as possible, I mean, a lot of us have been very familiar with CAMA 1990, and this whole process for getting very well apprised with the provisions of CAMA 2020 involves sessions like this where we are able to discuss some of the notable introductions, and over time we hope that we'll all be as proficient as we were with the previous law. So the first return highlighted here is as provided for in section 377 subsection 4 of CAMA 2020, and this provision is applicable to both companies limited by shares and companies limited by guarantee. And the subsection specifically mandates that directors at their first meeting after the incorporation of the company are expected to determine the date in each financial year the financial statements are made up, and to give notice of the date to the CAC within 14 days of such determination. That is within 14 days of the holding of such meeting. And I guess just as a side, I think I should just mention some participants may be aware that there was a deliberate effort to expunge details of applicable penalties for non-compliance with provisions of the CAMA 2020. I mean, at the time, during the review of CAMA, it was considered that, the penalties were not in tandem with the realities of, current day. We all know that that law was over, 3 decades old. So in a bid to avoid situations where each time you need to review such matters like penalties, you have to wait for a legislative review at the National Assembly. It was considered more expedient that it be taken care of by the company's regulations, since that can be amended by the Minister of Industry, Trade and Investment at every point in time. So that's why all penalties, as you would note from the CAMA 2020, is not specified in the law itself. So, and of course, you may also be aware that CAC released the company's regulations 2021 in January of this year, and that is what is now applicable. So really, with regards to this particular return, there's no penalty prescribed in the regulations, but from a compliance perspective, I think it is worthy of note when dealing with newly incorporated companies. And so some of us have situations where you're dealing with new subsidiaries which are being set up by existing companies, and then, they are constituted by a different board, and they have the first meetings, and sometimes people don't pay attention to these details. So I thought it worthy to just mention that we keep an eye as compliance practitioners or as persons who just generally deal with the affairs of a company, that we keep this in mind. So going up to the next one, another provision highlighted here relates to the change of name of companies, which is broadly provided for in section 30 of CAMA 2020. Now, whilst this provision, I guess, is not a statutory return per se, it is worthy of note to the extent that, the action for change of name after a decision to effect such change can only be effected after the approval of the commission is sought and obtained. So to the extent that the requisite special resolution of the shareholders is expected to be filed at the CAC, after which, of course, a new certificate, I beg your pardon, will be issued bearing the new name of the company. So this is one of the returns that will then be filed, or one of the filings that is expected to be done at the CAC. There's no time frame specified in CAMA 2020 for the filing to be done, and in the same regard, there's also no provision for penalty. So going on to the next one, the next filing relates to applications for re-registration of companies limited by shares. So in circumstances where a public company is desirous, I guess, of re-registering as a private company, or a private company is also desirous of re-registering as a public company, the requisite documents, I guess, covering this process, including the special resolution of the company, they're expected to be filed with the Commission within 28 days after the passing of the resolution. No penalty is prescribed for non-compliance, and the applicable provision in this case is Section 63 of CAMA 2020. Now, as regards return of allotment of shares, so companies limited by shares are required to file return on allotment of shares within a period of 1 month. This particular provision was a bit interesting for me, and I guess if anyone already also has insights on this during the Q&A, it would be good to share some of those insights, because it's not clear how this would operate from a practical perspective, in view of the fact that, as most of us may be aware, CAMA 2020 has now abolished the concept of authorized share capital. So you know that every company is now expected to have an issued share capital, even though, of course, there's still the transition period, which is ongoing for the next couple of years, to ensure that each company is able to comply with the new provisions of CAMA as regards issued share capital. But for the process for increasing what will now be the issued share capital has been amended to such an extent that when you then do an increase, you're expected to immediately issue the newly created shares immediately after the shares have been created. So it is really unclear how the 1 month period will continue to be relevant when you are not required to have any period between when you are not required to have unissued share capital at any point in time during the life of a company, at least in accordance with the new provisions of CAMA 2020. And so, just for your information, I have also highlighted some new provisions in CAMA 2020 in relation to return of allotments. So these provisions didn't exist before, and I thought that it was worthy of note. So first one is in relation to public companies, particulars of the valuation of consideration of the shares in circumstances where a public company agrees to accept payment of shares otherwise than wholly in cash. So this is the valuation process, which is provided for in section 162 of CAMA 2020. So in such a circumstance, an independent valuer is expected to be appointed by the company. And I know that some people may be familiar with this process. So the independent valuer will determine the true value of the consideration other than cash, and then prepare and submit the company a report on the value of the consideration. So this process is essentially articulated in section 162 of CAMA. So with respect to such companies, the particulars of the valuations is expected to also be submitted to the CAC when the return of allotments is being filed. Also, CAMA in 2020 introduced a new process where the commission itself can request for additional documents. So where for any reason at all, in consideration of the returns which has been filed at the commission in relation to return on allotment, and the commission for any reason requires any additional documents, it will give the company at least 7 days to produce such documents. So I thought that we should note this new change in the law. The next one has to do with notice of consolidation and subdivision of shares. So, and this relates to section 125 of CAMA 2020, which deals with such a provision. Now, it's applicable to public companies. And pursuant to this section 125 of CAMA, public companies, I believe, are required to notify the commission after there has been a consolidation or a division of all or any of its shares into shares of larger amounts, or where there has been a subdivision of its shares into shares of smaller amounts. So this notification is usually by way of filing to the CAC, and is expected to be done within 1 month of such notice. Where this is not done within the prescribed period, the company and every officer, and this would include the directors and the secretary of the company, will be liable to a daily penalty of 1,000 naira each until the default is rectified. So I know that one of the ways that was considered at the time by the draftsmen was to ensure that there was a relatively punitive penalty, just to ensure that compliance is done by the relevant officers of the company. So this would apply against the company and every officer of the company, and is a daily penalty. So in this slide, just before I move on, I've also highlighted the difference between the provisions in the 1990 law and the current law, just for your general information when looking at the provisions of this section. That is the section which relates to consolidation and subdivision of shares. So the next filing, which is also provided for in section 125 of CAMA 2020, relates to private companies limited by shares and their obligation to file a notice of consolidation of shares within a period of 1 month as well. Now, where there is non-compliance in this case, the regulations, that is the company's regulations 2021, also prescribes a daily penalty of 500 naira against the company and each officer of the company, of course, until the relevant returns are filed at the CAC. Again, in this particular slide, I have highlighted the differences between the provisions of the 1990 law and CAMA 2020 in relation to this requirement, just for your general information, just so that you can easily tell, the elements of the old law which has been expunged. And like I mentioned in my introductory remarks, I mean, my hope is that it would also serve as a resource document, so that at leisure you can take up the document and just basically catch up with some of the changes in CAMA 2020. So a combined reading of sections 271, 321, 330, and 339 of CAMA 2020 will deal broadly with notices of appointment, removal, resignation, and just general changes in the particulars of directors and secretary of a company, and which are applicable to companies limited by shares and companies limited by guarantee. So the provisions mandate the filing of such returns within 14 days of such changes, which is not terribly different from what was applicable in the old law. Where these changes are not filed at the Commission within the prescribed period, I think the only update with regards to this penalty, which has now been changed to a daily penalty of 1,000 naira each against the company and each officer of the company until compliance is undertaken in relation to the filing of these returns at the CAC. Now, Section 728 of CAMA, which relates to notice of change in the registered or head office address, requires companies limited by shares and companies limited by guarantee as well to file such changes within a period of 14 days. Otherwise, the company and each officer of the company would be liable to a daily penalty of 1,000 naira each. So I've highlighted again the previous provision under the 1990 law, which previously prescribed a penalty of 50 naira, a one-off payment of 50 naira under the 1990 law. Now, the next return relates to particulars of charges as prescribed by Section 222 of CAMA 2020. Now, under these particular provisions, companies limited by shares, that is both public and private companies, are required to file particulars of charges taken up by a company within 90 days. So, so I think this again is not radically different from what was obtainable in the previous law. Now, under Section 229 of CAMA 2020, where the charge has been satisfied in whole or in part, the company may elect to register a memorandum of satisfaction of the charge with the Commission. Now, since the language of this section is more permissive, and when you read the provisions of Section 229, I beg your pardon, you would see the use of the word may in that particular section. So since it's more permissive than obligatory or mandatory, it would explain why I guess that there's no penalty for non-filing. So while the provision is not mandatory, it is often desirous to file, such a document to improve probably the outlook, credit standing of the company, and also to provide adequate notice to third parties, or essentially notice to the world of the release of the assets of the company which had been charged. So while it is permissive, I think I should also mention that it is encouraged that these returns are also made at the CAC for the reasons that I've already adduced. Now, in relation to insolvency proceedings, and we know, or rather, some of us may be aware of the extensive amendments to the law in relation to insolvency practice generally, and so there's so many in terms of returns, in terms of filings that are time bound. That so I've highlighted a couple of them in this presentation, just so that we can also bear this in mind when we have to undertake any of these processes. So there's a requirement for filing of the appointment of a receiver or manager within 14 days of such appointment, and this is pursuant to Section 555 of CAMA 2020. Now, like the previous law, which did not prescribe a penalty for non-compliance, the regulations, that is the Companies Regulations 2021, has now prescribed a daily penalty of 1,000 naira against the receiver, the manager, the liquidator, or any of the officers of the company for non-compliance with this filing within the prescribed period. And so there's also a similar prescription for the appointments of administrators and also liquidators, as provided for in Section 483 and 654 of CAMA 2020, respectively. Now, both appointments, to see from the slides, they're expected to be filed with the CAC within 14 days, and failure to file such appointments at the CAC would also attract a penalty of 200,000 naira in the case of an administrator, and 25,000 naira in the case of a liquidator. Um, Now, this is in relation to notice of statutory declaration of solvency, as well as resolutions for winding up. Now, from a combined reading of sections 621, 634, and 625, notices of statutory declaration of solvency are required to be filed at the CAC within 15 days after the resolution for winding up has been passed. Now, while resolutions for winding up itself, they are expected to be filed with the CAC within 14 days after the resolution has been passed. Now, um, where the statutory declaration of insolvency is not filed within the prescribed period, I think the language of the law is that it shall have no effect. In essence, you may have to start to undertake that process again, and then probably also then file a declaration up to the new period that that the company has tracked. So, and where the resolution for winding up is not filed within the prescribed period of 14 days, the company and each officer of the company, including the liquidator, will be liable to a penalty of 25,000 naira each. Moving on. Okay, and so this point relates to 631 and 641 of CAMA, relates to notices of return of final meetings, also still part of the insolvency framework or provisions. So a combined look at those provisions, which mandates that after the affairs of the company are fully wound up and the general meeting has been held, the liquidator has a duty to send to the commission a copy of the account and make a return to the CAC of the holding of the meetings and their dates. And this return is expected to be done within 7 days after the date of the final general meeting. Otherwise, a daily penalty of 1,000 naira will also accrue against the liquidator. Now, under Section 733 of CAMA 2020, which deals with forms of statements to be published by banking, and insurance companies, deposit provident or benefit societies. So, as many participants are aware, there's a requirement for such companies to, before such companies commence business, and also on the first Monday in February and the first Tuesday in August in every year, during which it carries on business, to submit to the Commission a statement in the form set out in the 14th schedule of CAMA 2020, or at least as near to it as the circumstances may admit. Now, where this provision is not complied with, the company, the directors, and then in this case, the included managers of the company shall be liable to daily penalty of 1,000 naira. And so this provision is not new to the extent that, you know, categories, companies falling into these categories have always done this. But I guess the new aspect that's worthy of note is, you know, the penalties and the applicable persons to which these penalties would apply to. And so Section 418 and 421 of CAMA 2020 deals with annual returns. Of course, there's a prescription to file annual returns by companies limited by shares and companies limited by guarantee. This we're very familiar with. This filing is required to be done within 42 days after the AGM for that year. Otherwise, the company shall be liable to a yearly penalty of 25,000 naira. It is also noteworthy that failure to file annual returns for a consecutive period of 10 years is a ground for striking off of the name of the company's register. And so this is worthy of note for, you know, companies that have, you know, subsidiaries which haven't been active. You know, sometimes some companies have been set up, but whatever the direction or the business direction or whatever the reasons why such companies were set up were not actualized and they just continue to sit as part of the company. It's important that steps are taken to either do maybe voluntary members winding up or something, or otherwise where nothing is being done and then returns are also not being filed at the CAC, CAC can, you know, just take on that process for striking off the company off the names of the register. And I think that there's a process for relisting, but you would have to go to court to seek such order. So I think I've also highlighted a provision here, which is a new provision in CAMA 2020, a new process where companies may apply to the CAC for extension of time within which annual returns may be filed. This is a new provision. There wasn't anything like that in CAMA 1990. You either had to file it within that specified time, or or penalties will accrue. The only thing that was available was extension of time to hold an annual general meeting. So section 119 of CAMA, which deals with notices of persons with significant control and change in details of persons with significant control. This is applicable to both private and public companies. And some of us may be aware that persons with significant control, persons who hold 5% of unrestricted voting rights in the company. So there's obligations on companies to file details of such persons within 1 month from the date of receipt of the information. Otherwise, a daily penalty of 1,000 naira will apply, excuse me, against the company and every officer of the company. So these are the key highlights from the CAMA 2020 in relation to returns for, like I said, I was going to be taking it in terms of the different legal vehicles we have. So this essentially covers companies limited by shares, companies limited by shares and companies limited by guarantee. And of course, under companies limited by shares, we have both the public and the private companies. This new sets of slides just basically is to highlight some of the periodic filings, because these are also statutory returns for public companies which are worthy of note. So just generally to run through some of them, just so that because again the topic is statutory returns for CAMA 2020 and just statutory returns generally. So I thought that since I was taking the public companies as well, it would be useful to highlight some of the additional returns that are required for such public companies as prescribed by subsidiary legislation. So there's some notices that are required to be filed immediately upon the occurrence of any of the events there. So we have companies listed on the exchange. They are required to immediately notify the exchange of announcements of dividends, changes in capital structure, or other moves that could generally affect the price of the company's shares on the markets and changes in the board, alterations to the members and articles of the company, changes in the nature of the business, extension of time which are granted for temporary documents which have been submitted to the exchange, and any other information which would enable shareholders to appraise the position of the company, and just generally to avoid establishment of a false market in the shares of the company. Then we also have, in cases where the date and time when the board is to meet to discuss dividends, bonuses, or issuance of rights, they're expected to be filed with the exchange at least 14 days in advance. And then we also have notice of closures of the books of transfer, also decisions of the company or any of its subsidiaries to acquire shares in another company, which would become a subsidiary of that company, and another business or section of another business, and to furnish such information to the exchange with regards to such acquisition. Then also within 48 hours after the board meetings are held, public companies are expected, or listed companies are expected to, provide um, details around the drawings or redemptions of any securities, intimating at the same time the date of the drawing and the case of a registered security, the period of the closing of the transfer books for the drawings, and also the amount of security outstanding after any purchase or drawing has been made. Also within 48 hours, some of the things that, after the board meeting has been held for such companies, preliminary results for year, half year, quarterly, and comparative figures in respect to profits before tax and after tax, dividends and other distribution to members recommended or declared to be paid, short particulars of any proposed change in the capital structure or redemption of securities. These are all expected to be done within 48 hours after the relevant board meeting has been held. So the directors are generally responsible for ensuring that the exchange is promptly notified of also the foregoing matters. This includes vetting and approval of circulars and notices, which is required to be done not less than 14 days before their dispatch or publication. We also have supply of published accounts. This is also expected to be done at least 21 days prior to the date of the AGM of the company and not later than 6 months after the relevant year end. Then preparation, publication, and submission of accounts. This is expected to be done not later than 30 days after the relevant quarter and published within 5 business days in at least 2 national daily newspapers. Um, so also some of this, in relation to the accounts, they're expected to be, provided to the exchange, on a different basis. So the accounts to be filed not later than 60 calendar days after the relevant quarter. Also audited accounts to be filed not later than 90 calendar days after the relevant year end. Same thing for appointments of experts, consultants, or advisors. The exchange is expected to be notified by way of returns of the appointments of such professional advisors. Also, disclosure of material circumstances. So all information which relates to material circumstances that are likely to affect the financial conditions of such companies is expected to also be made available. Then disclosure of change in beneficial ownership of shares. Again, this was CAMA 2020 uh, took steps to align the provisions of the law with these particular provisions in the exchange, in the rule book, as well as um, the SEC rules, just so that, I mean, the previous provisions was 10%, I believe, and it was reduced to 5% to bring it in tandem with the more progressive provisions of the SEC rules as well as the exchange rule book. So this is expected to be filed not later than 10 business days after such transactions. Then records of transactions by insiders, also to be filed within a prescribed period, 10 business days after such transactions, and also records of transactions, to maintain record of all transactions and to provide it to the exchange, also within 2 business days of the exchange making a request for same. So that's actually going to be triggered by the exchange. Notice of adjournment of general meetings. This is also expected to be submitted to the exchange, and it should include information on the time and place to which the meeting is adjourned, or state that the meeting is adjourned to a time and place to be fixed by the directors. And this is to be done within 24 hours. So that is the details around updates for public companies. Just additional points to note. there are several others, but I just thought that these ones are worthy to note while we were discussing public companies. So going on to another legal vehicle, I'll now just go and share some updates in relation to incorporated trustees. Now, Section 832 of CAMA, which deals with change of name of the objects of incorporated trustees, requires details of such changes to be filed at the CAC within 15 days after the mandatory publication period of 28 days. So there's usually a requirement for incorporated trustees at the point of registration, and when you also want to make changes to the particulars of the incorporated trustees, for trustees to always do a publication in the newspaper. So after this publication is made, and usually notice to the public that these changes are going to be made, and it usually gives the public 28 days notice. So after the 28 days notice has been expired, this filing is now expected to be made at the commission within 15 days. Now, Section 834 of CAMA 2020 deals with replacement or appointment or and changes in particulars of trustees, and requires resolutions for such changes to be filed with the commission within 15 days after the mandatory publication period of 28 days. Again, the point that I made about the requirement for changes or just basically steps being taken in relation to incorporated trustees to be very transparent. So there's always a requirement for those publications to be made in newspapers. So it's after this has been done that you're required to make the filing with the commission within 15 days from the date of the mandatory publication. Now, incorporated trustees are also obliged under Section 848 of CAMA 2020 to present annual returns to the Commission every year, and this is not later than June 30th, not no, I think not earlier than June 30th and not later than December 31 of each year, except the year of incorporation. Now, where this is not done, the trustees are liable to a yearly penalty of 10,000 naira each. CAMA also has introduced a new requirement that I think that quite a number of people are not very familiar with, but because of the attendant, you know, implications for non-compliance, I thought it worthy of note to bring it to your attention that Section 845 of CAMA 2020 now has introduced a new requirement for incorporated trustees to submit biannual statements of affairs to the Commission no later than 15th of July and 15th of January of every year. Now, this is provided for, like I mentioned, in Section 845 of CAMA 2020. Now, where this is not complied with, each trustee will be liable to a daily penalty of 500 naira each. Now, CAMA 2020 also introduced a new process for merger of incorporated trustees. This wasn't applicable or available, rather, in the 1990 law. It's Section 849 of CAMA 2020 provides for the process for merger of incorporated trustees. So where two or more associations with similar objects intend to be merged, the associations have a duty to notify the commission within 15 days of taking that decision. Now, the regulations does not provide for any penalty for non-compliance, but this essentially is a return that's supposed to be filed at the CAC to ensure that this process is consummated. So Section 833 of CAMA 2020 deals with notice of alteration of the Constitution, which is required to be filed within 15 days from when the resolution to alter has been passed by a simple majority of its members and approved by the Commission. So where this provision is not complied with, a penalty of 10,000 naira is applicable or against the trustees of the company. So that is those are the key returns that are worthy of note in relation to incorporated trustees. So moving on quickly to business names. So we have under Section 862 of CAMA 2020, it requires business names to file annual returns no later than 30th of June of each year, except for the year of registration, of course. Now, where this is not done, there's also a penalty of 150 naira per day, which is liable against the proprietors of the business name. We find out that there's quite a number of non-compliance with business names. However, quite a number of professionals, especially professional advisors, are registered as business names. And so it's important that we bear this in mind, the timelines, and also ensure that those companies remain up to date in relation to filing of such returns for compliance reasons. Now, Section 818 of CAMA relates to changes in any information provided at registration for business names. So quite a number of information is provided during the process for registration at the CAC for business names. So where changes are being made for any of the information, whether it's in relation to the address or the business objects of the company or the proprietors. Now, these changes are expected to be filed with the Commission within 28 days after such changes have occurred. And where this is not done, a penalty of 150 naira shall, immediately start to accrue against the proprietors of the business name. So this is also important that we bear this in mind when dealing with business names and ensure that the relevant um, returns are filed. So I'm now going to move on to talk a little around some of the general tax returns, also statutory returns, that as compliance professionals or as corporate governance professionals that we should actually bear in mind when dealing with companies and ensure that these returns, even though we have external advisors, a lot of times financial advisors who work on this, or sometimes it's even internal. We have people in house who undertake these filings. It's important that we are also able to track it because the responsibility for compliance ultimately, rests with usually with the compliance or the corporate governance professionals within the organization. So I thought it useful to mention, some of these tax returns during this section. Now, the first one has to do with filing of value-added tax returns to the FIRS as the Federal Inland Revenue Service. And so I've cited the relevant provisions of the law, as well as, we're aware of the extensive amendments to a lot of these tax laws by the Finance Act of 2019 and also the Finance Act of 2020. So I'll be highlighting a couple of them. So this is the frequency, of course, is monthly and is to be done on or before the 21st day of the preceding month. And now the penalty for failure to file VAT returns is 50,000 naira in the first month of default and then 25,000 for subsequent months in which the failure continues. And this is applicable to all companies, of course, but it excludes small companies. And of course, for tax purposes, I believe that we're all aware that for tax purposes, small companies have been defined as companies with 25 million or less in terms of turnover, and also excluded. And this is also applicable to business names. So, say for the small companies as defined under the Act, and of course, we are aware that the company's regulations has also synchronized the provisions of CAMA to bring it in tandem with the provisions of the Finance Act in relation to the definition of small companies. So, so those small companies are exempt, but this particular provision applies to all companies and business names. So for filing of withholding tax returns to the relevant tax authorities, I have cited the relevant provisions of the tax law, and this is to be done monthly and is also on or before the 21st day of the preceding month. Failure to deduct tax or to even remit the taxes which have been withheld attracts, upon conviction, so you go through a process, a penalty of 10% of the amount in default plus interest at the CBN minimum rate discount rate, which is now been replaced by the MPR, that's the monetary policy rate, in addition to the amounts which were not withheld or not remitted. And this provision is applicable to all companies and business names. So in relation to pay as you earn returns, which we all understand to be returns that are to be filed with the state inland revenue service of each state, including the FCT. It's to be done monthly. Sorry, excuse me. Yes, it's to be done monthly, and the timeline is on or before the 10th day of the preceding month, and is applicable to all companies and business names with employees on their tax on their payroll. Filing of company income tax returns, the relevant provisions of the CITA, that's the Companies Income Tax Act, as well as the Finance Act, has been cited. It's to be done annually, and it is to be done within 18 months from the date of incorporation in the case of new companies, or 6 months after the accounting year, or whichever is earlier. Now, penalty for non-compliance is 25,000 naira for the first month of default, and then 5,000 naira for every month that the default continues. And in addition to that, upon conviction, the responsible officer of the company, that's the person responsible for filing the returns, may in addition be liable to a fine of 100,000 naira or to 2 years imprisonment, or both. And it's applicable to all companies operating in Nigeria, excluding companies engaged in petroleum operations. Uh, Trying to change my slide. Okay. Then filing of annual payee returns with the relevant state inland revenue service. This is to be done annually, and it's on or before the 31st of January of every year. And penalty is 500,000 naira. And then applicable organizations is the companies and business names. There are also transfer pricing returns which are required for companies to which this is applicable to. This is done annually and is to be done within 18 months from the date of incorporation, or 6 months after the accounting year end, whichever is first. Penalties is 10 million in the first instance, and then 10,000 naira for every day in which the default continues. So all companies transacting with related parties essentially would be the applicable organizations to which these provisions relate to. Then there's the education tax returns, cited the relevant provisions of the Tertiary Education Trust Fund Establishment Act. This is to be filed annually, and the timeline is 60 days of an assessment notice from the Federal Inland Revenue Service. And in practice, we find that it is filed alongside the company's income tax returns. Now, penalty is 5% of the tax, inclusive of the principal tax. And then where default continues after 2 months, the following penalties will apply. First offenders will get 1 million naira or imprisonment for a term of 6 months, or even both. And then second or subsequent offenders, 2 million naira or imprisonment for a term of 12 months, or both. Now, this is applicable to all Nigerian companies. Then we have the estimated petroleum profit tax returns, which is done annually and is not later than 2 months after the commencement of each accounting period. Now, late submissions of the petroleum profit tax returns attract an initial penalty of 10,000 naira and 2,000 naira each day for each failure, where each failure continues. So the applicable organizations are the companies which are involved in petroleum operations in Nigeria. Then we have the Capital Gains Tax Act. There are certain returns that are supposed to be filed biannually, and the penalties as prescribed, under the CIT, and it's 25,000 naira for the first month of default, and 5,000 naira for every month. And then it also has liabilities for fines and imprisonment. Now, penalties attracts upon conviction a penalty of 10% of the amount in default, or of course, at the relevant MPR, and then in addition to the amount that was actually not remitted as well. So all companies or businesses that dispose of chargeable assets for which the capital gains tax would accrue would be the applicable organizations in this instance. Then we have the actual petroleum profit tax returns. This is to be done annually, and this is within 5 months from the end of the exploration and production companies accounting period. So late submission of the petroleum profit tax returns, that is the actuals, attracts an initial penalty of 10,000 naira and 2,000 naira for each day such failure continues. So again, the applicable organizations in the instance case are companies involved in petroleum operations. Then we have this country by country report, and this is applicable to companies, ultimate parent entities, which are tagged ultimate parent entities, or a constituted entity of a multinational enterprise that is a tax resident in Nigeria. So this report is expected to be done annually for such companies or for such organizations, and is to be done on or before 12 months from the last day of the reporting accounting year of the particular multinational enterprise. Now, penalty is 10 million naira for non-submission of this annual report for the first month and of default, and then 1 million naira for every month the default continues. Then we have this the NICTA levy, um, and of course, citing the relevant provisions of the National Information Technology Development Act, that's the NICTA Act. This is required to be done annually. It's applicable to GSM service providers and all telecommunications companies, also to cyber companies and internet providers, also to pension managers and pension related companies, banks and other financial institutions and insurance companies. And this is expected to be done within 60 days of service of a notice of assessment. In practice, companies self-assess the tax. That's what we have seen, that in practice they self-assess the tax along with the CIT returns. Now, penalty for non-compliance is 10 million naira for the first month of default, and then 1 million naira for every month the default continues. I'm aware that they haven't really been implementing these penalties, but I think for purposes of just noting what are the compliance requirements in relation to this particular levy, I think it's important that if we service or if we work for any of the applicable organizations which fall into this category, that we bear this in mind, even as NITDA continues to take steps to improve its own monitoring of compliance with the provisions of the law. Okay, I mean, so that generally ends discussions around specific provisions of the law which trigger certain actions to be taken and filed with the applicable regulator. In this case, of course, the more general, the brief was for CAMA 2020, really, and then to talk more about related provisions which were incidental to those legal vehicles in CAMA 2020. Deliberately not talked around the very new legal vehicles like the limited partnerships and the limited liability partnerships, just because that in itself is a topic on its own, and CAC hasn't even deployed the technology solution to bring those companies into operation. So what we I am aware that the registrar general is taking assiduous steps to ensure that those companies come upstream very soon. And so I don't know if this would be a good time to take some questions or maybe just quickly wrap up. In terms of timing, I think we're making good time. So, or talk more around, the concept of regulatory compliance and what we can do to ensure that we have good systems in place that support our roles and responsibilities for ensuring those obligations are met at every point in time, whether as in relation to the clients who we serve or whether in relation to the companies who we work for. So, oh gosh, my system has started to be unstable again. Just remove the video. Um, so regulatory compliance. Okay, this is okay. Sorry, my slides were frozen for a few seconds there. So, I mean, just talking more general, and I guess this is more relevant to the younger associates both the student members who hopefully joined this session, as well as the younger associates. So talk more around this concept, and then later on in the session, we'll talk more about some pragmatic or practical steps that one can take to just ensure that you you stay up to date on your obligations in tracking all those regulatory compliance obligations. So generally, and I guess broadly, regulations are implemented to protect someone or something, whether they are employees or consumers or the public, or the integrity of the business processes. So in its simplest form, it's just to make sure that organizations follow all applicable rules and standards which are set for the particular industry in which the organization operates in. So depending on the industry, the nature of the regulatory compliance, of course, will vary. So regulatory frameworks are constantly evolving across sectors. In fact, arguably, quite a number of people tell me these days that, and I'm almost I almost want to agree that we're over-regulated, that as a country we're over-regulated, and I think maybe this may have informed more recently the news in the media, where the Honorable Minister of Finance were talking around merging of some of the existing, I think, ministry agents or agencies and departments. I know that that is being driven by the workforce, but I imagine that in the course of that process, where they do when they do get round to implementing that, there will hopefully be a situation whereby duality of functions will also be reduced, and companies and corporates across the country would get some succor out of that process as well. So as transparency rises in terms of importance across, and this is really across the world, and the costs of non-compliance with laws and regulations increase, and we've seen it even in KAMA, in some of those provisions that I highlighted, seeing where sanctions or penalties have moved from 50 naira one off to situations whereby it is now 1,000 naira per day against every officer as well as the company of a company. So businesses everywhere are trying to adapt to the growing pressure from regulatory bodies to comply with the extant rules or regulations which have been prescribed by such regulators. So I've drawn on some examples here where, as a result of non-compliance, just essentially highlighting the exposure that could occasion as a result of non-compliance, and why it is critical that we have systems in place to ensure that at every point in time, the organizations that we serve or that we work for are are in compliance with whatever provisions exist or in relation to that particular industry, even if, like the NITA case where they're not doing a lot of monitoring, because I hear that a lot from some practitioners who say, oh well, but you don't monitor it, so why do I really need to comply? We've even found situations where sometimes some of these things have some of these regulators have decided to audit, way back, where companies are then given the burden of providing evidence that they complied. So the owners of burden shifts to the company. Show us that you filed this. Show us evidence that you have acknowledgement stamps of having filed certain documents, even if they were not monitoring compliance at the time. So I don't think it's a tenable excuse to give. So I think it is more to just stay on top of those compliance obligations, regardless of whether or not companies are enforcing, monitoring or enforcing such obligations at any point in time. So, drawn on the case in 2015 where NCC imposed a very high penalty or fine against a telecoms company in Nigeria. We also have in 2016 where CBN fined four banks for various regulatory breaches. And also between 2018 and the first quarter of 2020, the stock exchange, Nigerian exchange rather, boosted its revenue with 150 million naira from fines imposed on listed companies across, different different industries, banking, manufacturing, insurance, amongst other several regulatory infractions. And these really are monies that ideally should be going towards the business, to operations of the business, or towards shareholders, to be going into their pockets. But as a result of, just, breaches and just basically lack of commitment to overseeing whatever obligations these companies were expected to be doing at every point in time, it occasioned this sort of expenses or infractions, which led to this sort of financial exposure. So in the corporate business environment, there are certain requirements that need to be met in order to, ensure the effective operation of businesses in Nigeria. And so where compliance is adhered to, it brings about, of course, sustainable development to that organization. At least at the minimum, it saves a lot of exposure. And also, so due to the vast number of regulatory agencies and compliance regulations in Nigeria, a lot of businesses find it difficult to keep up. Sometimes these things also pop up. They're often caught unawares, unprepared, sometimes even ignorant of compliance requirements until it is too late. Because again, transparency has been an issue with a lot of our MDAs, that is, with Nigerian MDAs. It's only very recently that they have been mandated, I think, under the Executive Order 001 to essentially update their websites. Previously, you find that when you go up to websites, you will just see pictures of the MD attending events, and maybe they'll give you details of who is the board member and the chair, and very little information around processes, around documents, around timelines. But since then, since the Executive Order 001 was launched a couple of years ago, I know that some of the MDAs have taken to doing this, some better than others. Some, of course, have been recalcitrant and haven't really hasn't gotten on board the train on just basically improving transparency. And this often leads to this situation that's been painted where we're caught unawares or unprepared and even ignorance of such compliance requirements until it is too late. That is until they slam the company with the infraction and the fine for payments. So a regulatory compliance officer, a lawyer, excuse me, is tasked with the responsibility of ensuring that the organization or firm takes all necessary steps to comply with relevant laws, policies, and regulations applicable to it. So, knowledge of operations within a particular industry is a significant part of being a successful compliance lawyer or practitioner, I beg your pardon. So, I'm just going to highlight what I believe is a strategic approach. So, excuse me. Yes, a strategic approach to regulatory compliance. So, as a first step, I think that one of the things that could help in the process of tracking compliance is to identify applicable compliance requirements for your industry. So, whichever industry you serve or clients that you serve, I think that it can be categorized in three broad, categories. So there are general compliance requirements, which are applicable to all industries, regardless of the size and activities. And we've talked a little around some of them that has been provided for in CAMA 2020. I also talked around some of them in relation to tax, tax returns. And then there are some core compliance requirements, and these are essential requirements for any business, especially businesses in regulated industries. So it's important that these are considered core requirements as undertaking businesses. Without these requirements, such companies, organizations will be in breach of sectoral regulations. So compliance requirements that fall within this category includes those obtained from sectoral regulators like NAFDAC in the event that you're doing the sort of businesses that would entail filings or registrations with NAFDAC, CBN with the categories of companies that are regulated by the central bank, and PENCOM and SEC, and then so many of those sectoral sort of like agencies or regulators rather. Then we also have the peripheral business requirements. So while still looking at the core and the general compliance requirements, it's also very important to keep an eye on the ones that are not core to the business operations, but they are required for ancillary activities and operations of the companies, because quite a number of them also have significant financial exposures where there's been infractions against those provisions. So it's important to also keep an eye on them and have a system in place for tracking compliance of those business requirements. So examples: signage permits, advertising and branding permits, even waste management registration and fire department certificates. In a particular case, there was a particular case where the operations of a particular company was grounded for I think about 2 weeks on the ground of waste management, some issues around waste management. So I guess I'm just saying this to point out that while this may seem peripheral, it can be very damaging to the operations of the business. It can also be damaging to basically the impression or the brand or the image of the company, and of course the financial exposure that would occasion such infractions. So it would be good to group them and have a way of tracking them. So once they're grouped like this, you're then able to then have a fairly good idea of the regulatory requirements that you would be required at any point in time, and to be able to track compliance. Then also to identify the applicable tiers of compliance. So grouping them also to note the ones that are applicable under federal laws, because there's some compliance requirements that are occasioned by the federal legislations, like the CAMA, like the also the Federal Inland Revenue Act, and or the tax laws that are of federal nature. And then we also have the state regulations. So it's not uncommon to find that there's always a need to obtain permits for more than one state regulator for a business activity. So examples of state compliance requirements including procurement of building permits and approvals from the State Building Control Agency, fire safety certificates from the State Fire Service, also tax registration with State Inland Revenue Service. So this is also another booking. And then of course we have the local regulations as well. The local government in each state also prescribe certain compliance requirements such as tenements rates, motor park levy, signboard advertisements rates, various ones. And I think in terms of practice, quite a number of those ones are the ones that catch people unaware. And so there's just a need for there to be some kind of institutionalized way of tracking developments in that and just not being caught unawares. But the first thing is to just basically stay abreast of what those requirements are, and then have a process for tracking compliance. Then we also have different types of remittances. So you could identify the different types of remittances. Depends of how frequent those remittances are expected to be made. So registered entities are required to remit different types of taxes, levies, and contributions to regulatory bodies. General applicable taxes and levies like, companies income tax, industrial tax fund, the NSITF as well. There are also remittances by individuals, which includes things like, the payee tax, and also pay tax for employees and also business owners. So that's for business name proprietors who are expected to remit personal income tax on the income that they earn to the relevant state tax authorities. Then we also have remittances by transactions. Some remittances and taxes are due and chargeable on transactions undertaken by a business. So this is VAT, WT, CTT, and those are some of the things that I touched on when we're talking around the tax returns. So this grouping also could help also in essentially formulating a process at the back end in terms of your having to deal with those compliance requirements, and just grouping them just may ensure that you then have a more efficient flow of addressing them. Also know the frequency of compliance. So for different types of compliance obligations, sometimes you have one-off requirements where you have to do it just once in a particular year, or even just one-off generally. And then there are some that are recurring, they are of a recurring nature. So after fulfilling the one-off compliance needs, you also have to then comply with recurrent requirements to maintain compliance status, and it's usually periodic and requires certain documents to be filed or costs to be paid. And so most regulatory compliance pitfalls can be found here, as this category includes filings, returns, assessments, renewals required from several bodies across all tiers of government. And we've highlighted some during the earlier discussions.
Hello. Hello, Mrs. Bashir. Hello.
I think I did.
Yeah, okay. Yeah, you are back, man.
Okay.
You were off momentarily, yes.
Okay. Now I'm not sure how far back I'm supposed to go.
You may need to
Go back a slide.
Okay.
Okay. Yeah.
All right.
I'm so sorry about that. It was why I took off the video, because the network was showing me signs of being unstable.
All right.
Okay. Sorry, let me just go back. I mean, so this was the slide I think that I was talking of. I got logged out. Just basically to know the frequency of the compliance requirements. So I'd mentioned that sometimes there are one-off requirements. You find that they are expected to be procured once in the life of a business, unless there's a change in the business objects or status. So, for instance, licenses, which are issued by the regulatory agencies, such as where you want to operate a bank.
Sorry, Mrs. Bashir. Sorry to cut you. Sorry to cut you. We can't see your slide.
Oh, I see. Okay.
Yeah.
Okay. Let me do that again then. I think I'll stop sharing, then I'll start it again.
Yes.
Okay. Can you see it now?
Yes, we can see it. Yes, we can see it.
Okay, thank you. So so this was a slide that I was speaking to when I got logged off. So I was just basically also making the point that also knowledge of the frequency of the compliance requirements helps in grouping as well as tracking compliance. So knowing that in certain cases there are one-off requirements. So compliance requirements that are expected to be procured once in the life of a business, unless there's a change in the business object. So I'd mentioned as an example, licenses issued by regulatory agencies such as CBN. So in a case where you're setting up a bank and you get a license for banking activities, it's not something that you have to, basically get over and over again. The license stays, but then there are also recurring requirements. So after fulfilling the one-off compliance needs, so some businesses also need to comply with some recurrent requirements to maintain compliance status. Also, these are usually periodic and require certain documents to be filed or costs to be paid, as in fees to be paid. So most regulatory compliance pitfalls I've highlighted here usually are found in this category where they're recurring. And this includes filings, returns, assessments and renewals required from several bodies across all tiers of governance. So these are some of the ones that we've highlighted in the course of this discussion or in the course of my presentation. Trying to move to the next slide. So developing an internal regulatory compliance structure. So this is more around the practical things that I think may be relevant, and I would be happy to to hear from other practitioners who have devised, novel methods for also ensuring that they stay on top of this obligation. These are just a few of some of the things that I thought that I should bring to the fore. And so, of course, we'll be happy to then get insights, also happy to learn from some of the esteemed participants who are on the call to, basically share some of the things that they have also developed internally to support them in executing their own roles and responsibilities, either in the companies that they serve or as clients, or the companies that they serve as employees, just to provide that service. Now, a streamlined compliance dashboard policy document could be developed indicating the compliance obligations, who is the personnel responsible on the team, what's the time frame, what are the penalties for non-compliance, so that you have just basically something internal, an internal document that you use to chat to track compliance. But I guess the key thing for when you do develop this sort of document, the key thing is to also have a process for updating same periodically and not too short a time, to have persons who are responsible for updating, for tracking developments, for monitoring websites or whatever it is, because like I said, transparency has improved for some of the MDAs. Some you can actually rely on some their updates that they provide on their website. Some you probably have to develop, some level of engagement and relationships with the relevant regulators to be able to stay on top of whatever they're doing. So that way you're part of even the conversations when the policies are being contemplated, and then you know when to expect implementation of such policies. So identifying compliance requirements may involve visiting regulatory agencies in order to map out the compliance obligations and get a clear or clearer understanding of the expectations of the regulator. So I guess this is at the beginning where you are in a place where this hasn't been established. This will probably be one of the most responsible things to take on first. And so where you have already that in place, or where you join an organization that has that in place, then you can then work on the updates and also improving your own relationships with the relevant regulatory agencies. Then periodic compliance health checks or audits may be needed to assess and identify compliance breaches and lapses within the company in order to put measures in place to rectify same. So again, because sometimes there are different moving parts in an organization, it's important to be able to track compliance. So for instance, tax, sometimes these are not done by the the sort of participants that are on the call, but then you have to ensure that you liaise with the relevant persons, personnel departments or external advisors who provide this service or who provide these functions, to be sure that those compliance requirements are being done and there have been no breaches or lapses. Because again, sometimes when they don't have a good system in place, those things do occur, and ultimately it falls on the organization. It's not going to be something at best. You probably have some measure of indemnity, but it will still fall, the axe will still fall on the organization. Then to watch out for milestone compliance requirements. Some requirements only become applicable as the company grows. So also note that, and then of course, an example could easily be around PENCOM requirements, where you have increase in number of employees or rise in annual turnover. So for instance, a company which is transitioning between a small company and a company other than a small company, you need to be able to know when you cross the relevant financial threshold, and then to know that additional compliance requirements will be applicable, and to be able to ensure that those are also addressed immediately that transition happens. So along with the transition, those are some of the things you have to be tuned into, that so what are those additional or new compliance requirements that are based on certain milestones being undertaken by an organization at every point in time. Now, creating awareness on compliance obligations and developing checks and balances to ensure internal objective congruence within the operating unit. And I think I've talked a little around that because, like I said, sometimes there are different moving parts, but it's important to just ensure that you're able to see across the different operating units, in a seamless way, in a continued way, in a structured way, and possibly in an institutionalized way, because it is only when that is in place that you can successfully then say that you are running a very efficient system that cuts across, and then you minimize exposure to infractions, that can then lead to exposure of undue exposure of the organization. Then, following developments in the law through monitoring of activities at the national and state assemblies, so as to assess, impact of upcoming laws ahead of passage, makes one less reactive and more proactive in preparing organizations for imminent changes as a result of such laws. So, again, this is something that is pretty important, and I think that the National Assembly more and more tries to make this a more transparent process. I know that they do publish fairly regularly votes and proceedings in relation to whatever occurs at the National Assembly at each plenary. So looking at those, if one is able to track, especially from the onset, that is from the beginning of a session of the National Assembly, a new session of the National Assembly, when a new government comes into place and follows, plenary sessions, you are able to then immediately track, the sort of bills that they're considering for passage. You would then know when the requisite bills go through first, second, third reading and then passage. And then more importantly, you're able to access, to the extent that those bills are relevant to your organization's business or may have an impact on your organization's business, you are then able to review, you're able to advise, you're also able to set in place, any sort of measures that needs to be put in place to minimize the impact of of the passage of the bills. Now we know that sometimes some of these laws do not get to be passed in that particular session. They may start the process, they may even pass it on one chamber, whether at the Senate or at the House of Representatives, but they're not able to have a passage on both chambers at the end of a session. That basically leads to the end of that process. And I think because this happens a lot, a number of people don't pay attention to the laws. I mean, very easily, I've had conversations with people around some provisions of KAMA, for instance, and just being very passionate about some of the provisions that scale through and just being vocal about why they shouldn't have gone through, but then never having made representations during public hearings or even bothering to read any of the drafts that were available to be reviewed at the point when those changes could have been effected. But so we find a lot of reactive persons in our in practice who don't look at this. But you see, when your organization and the people that you serve are going to be affected, it's very important that we actually take active steps and deliberate steps, intentional steps to ensure that we have a process for monitoring those activities and to reviewing those provisions and advising the relevant management of the companies we work for or the clients that we serve, just to minimize the impact. Um, Also, non-compliance, and I think I talked a little around this, or non-compliance can hurt fundraising or merger attempts, as due diligence will be undertaken on the business by investors, which will consider regulatory and compliance risks. I know that quite a number of us are familiar with the fact that where you have, you're raising capital for companies, or you're inviting, investors to join, one of the things that such investors, at least a right thinking investor, would do is to conduct due diligence. And, some of these things are pretty important to them to see how you've been running. And this is why we talk a lot around corporate governance and why it's important. How the company is being run, of course, is important. And also how the company has been in terms of the compliance levels of such companies, because it does say a lot about how that company is run. So you find that when red flags are raised during this due diligence exercises where reports are sent, some investors actually shy away from investing in such companies and would rather, pitch their tent or put their money in places where the company has taken more steps to ensure that they were compliant with all, if not with most, if not all, of the regulatory requirements for such companies. So, obtaining licenses, permits, and approvals can be, a pretty difficult task between documentary requirements that you have, between tight timelines. We also have the bureaucracy in our MDAs and also have the high cost. And then more recently, we also have COVID-19. So these processes can be a Herculean task. So it's important that you start early. You start from the onset. You understand what you're expected to do at every point in time. You start early. You put your systems in place to ensure compliance, and then just generally that you minimize exposure of the companies that you serve, or the clients that you serve, to financial and erosion of brand as a result of non-compliance. Also very damaging to also our careers as practitioners in that space as well. So I think on that note, and I think I really made a good time. This should be exactly 90 minutes, I think, if you can confirm. Thank you all for listening. And again, thank you for participating in this workshop.
Thank you very much, Mrs. Bashir, for that very well detailed and researched presentation. I'm sure the participants have definitely learned a lot from your wealth of knowledge. Now we'll proceed to questions. Please, if you have any questions, please just drop them in the chat box. Then Mrs. Bashir can indicate if she wants you to unmute your mics and ask your question. Any questions, participants? Kindly drop your questions in the chat box, or you can just raise your hand so you can be unmuted and you can ask your questions. Any comments, suggestions, opinions? Uche Mekwe says, thank you very much, ma'am, for these highlights. All right.
I guess for the participants, it's more around just ensuring that I guess there are just quite a number of things for them to note. Just like I mentioned in the introductory remarks, that we're all grappling with this our big legislation as CAMA 2020. And I think again, stating again for the benefit of the people who had not, the participants who had not joined at the start of this session, that this is an effort by the institute to just ensure that we all get to know the provisions of this new law in a more in a concerted way, because really a lot of times until you have those situations you don't actually go looking for the information. But by attending this sort of sessions that the institute has put in place, then people are able to get more and more familiar with it, and hopefully we can get back to the time when each of us could talk easily about the CAMA 1990, and it would be the same for CAMA 2020. And then I like to think that they've noted the ones that they could note, and that they would probably be using this document as a resource, sort of like a resource document to check up on these things from time to time. And with time and just basically concerted efforts to continue to familiarize yourself with these requirements, we can all be the regulatory compliance practitioners, to the extent that you are one or that you want to be one, that we should be. And that would be to the credit of the organizations that we serve or the clients that we serve. So I guess that is fine.
Okay, thank you very much, Mrs. Bashir, for this wonderful presentation. Well detailed, insightful, and very, very inspiring and revealing. Thank you very much. We can see some comments from and questions from the chat box. Okay, we have a question there. Just a minute. Let me get the question. Someone is asking if there is any website where the information Okay, Ma, please, aside from the news, are there platforms or websites where one can keep up with new laws and policies?
I mean, so the National Assembly has one. There's also, I think, a non-governmental agency called PLAC. They receive funding, I think, from the British government to provide that service. So you can also check the website for PLAC. You can check the National Assembly for votes and proceedings. They talk about the bills and then also put updates when the laws are passed. In terms of sectoral updates, it will depend on the age, the type of organization, and I think I spoke a little around that. So where is a public company, you have to make sure you keep your eye on the SEC website, where it has to do with banks and other financial institutions. I know CBN is very good at that. Their updates are usually on time, circulars, notices, you'll find it on their website. So some are more diligent than the others. Some others, unfortunately, you have to do one-on-one engagements, which is why I spoke around developing relationships with your regulators, especially where you work in where you work for an organization in a regulated space. You must develop that relationship because those one-on-one engagements helps you to stay on top of when policies are even being sort of like contemplated. You are even part of the discussions, and then you're able to then track when they come into place. So that affords you opportunities to react before it is put in place, and also to prepare yourself or your organization for implementation when that does also come into being.
Okay, thank you very much, Ma, for that. So let's scroll and see what we have again. Mojishola Virtue is thanking Iksan and Mrs. Bashir for this session. Okay. Are we allowed to raise any question on KAMA? Okay, let me see. Okay, Esesu Ibironke says some of the penalties state that every person in the company will be fined with a certain amount of money as a penalty for default. Does this mean every staff in the organization or just the person or management responsible for the delay?
I mean, so it's usually the company itself. So the company is deemed a person, so the company, and then every officer of the company. So in that case, it will be the directors of the directors at every point in time, at the time of the infraction, I beg your pardon, and also the company secretary, where it relates to a company that has a company secretary in place, because of course we know that KAMA has also made provisions to make it not mandatory for certain types of companies. Yeah. So it's not
Okay.
everyone in the company. Yes.
Okay. Thank you very much for your response. Okay, let's move down. Someone from Mariston is asking, CAC released a new company's regulation with certain penalties according to the type of company, that is whether the company is a small company or private company other than a small company. Now it says, how can one tell the difference between the two?
So KAMA is actually very clear on what are small companies and what are companies other than small companies. There's a definition section for small companies, which was revised more recently in the company's regulations. So there was an effort by the CAC to bring the provisions of KAMA in line with the provisions of the Finance Act. The Finance Act had gone on to define what are small companies, and it was actually very radically different from what was in the law itself. But in the law, there was a proviso that the amounts could be as prescribed, by, I believe it was the Honorable Minister at every point in time. So the Honorable Minister utilized the company's regulations in amending the provisions or the definition of the small company by aligning it with the provisions of the tax law as as put in place by the Finance Act of 2019. And I think that the regulations also say that or any additional definition, because you know that there's also a push to still increase. Right now it's 25 million or less. That's when you're exempted for tax, but there's still conversations about increasing that to a higher amount. So the regulation says that it shall be as prescribed in the Finance Act from time to time. So the CAC will also continue to update as government expands the definition of small companies. We hope they expand. We hope that government expands the definition of small companies to increase it from 25 million. So that's where you can actually determine the differences between the two types of companies.